Assalamualaikum warahmatullahi wabarakatuh. Good afternoon to all my students. Today I will continue our lectures on the issues in international finance. Content of the lessons. In this topic, we will learn about exchange rate and currency in international business, explain how exchange rates are determined, understand the emergence of the modern exchange rate system, describe monetary and financial system, identify the key players in monetary and financial system, and last, we will try to understand the global debt crisis. For introductions, money and finance can serve political as well as economic purpose. At international level, the answer to the following have profound political implications. What money should be used to facilitate international economic transactions? How should such money be managed? What should the nature of the relationship be? National currency be? How should credit be created and allocated at international level? Globalization of financial market. Globalization of financial markets started in the 1970s but accelerated after beginning of 1970s. How do we explain this phenomena? There are many reasons contribute to globalization of financial market, and it can be explained by improvement and growth of technology, growth of international trade and multinational activity, recycling of oil money after 1973. So what is oil money? So I will explain in detail about oil money. Oil money term suggests is wealth that being acquired through a petroleum industry, typically industry focused on extraction and refine of crude oil in order to produce several products such as gasoline, fuel, oil, and plastic. Oil reserve can be found across the world, but the regions mostly associated with the resource are a Middle East, including countries such as Saudi Arabia and the United Emirates, Russia, and North America. Football clubs that are said to be run on oil money, who receive investment from business involved in petroleum industry. So which club benefit from oil money? So here we have many actually. I get some only. For example, we have Chelsea, sponsored by Rome Abramovich, Shakhtar, Zenit, Russia Club, and Real Madrid, AC Milan, and Arsenal. They are sponsored by Emirates Group and Dubai-based business. Sport grant access to unique global market by bringing certain level of prestige, particularly so when it comes to the success club. Next factor contribute to the globalization of financial markets is volatility of the currency environment after breakdown of the Bretton Woods, encourage international diversification of investment. Bretton Woods system create a collective international monetary or currency exchange regime. Bretton Woods system established a system payment based on the dollar, which define all currency in relation to dollar. Dollar itself convertible or exchangeable to gold. Currency in the world use US dollar as yardstick. So $1 equal to how many Malaysia ringgit? $1 equal to how many yen? So for example, I select Malaysia ringgit into equal to $1. 4.145 Malaysia ringgit equal to $1. And then we have innovation in monetary, in financial industry also contribute to globalization of financial market. Innovation in financial industry, we have fintech. Sharing economy will embed in every part of the financial system. For example, we have a car, taxi, hotel rooms, provide online booking platform. They are using integrated financial system. Digital financial become a mainstream, so it help a lot for the globalization of financial markets. Customer intelligence. Another innovation in financial industry is customer intelligence. Customer intelligence refer to how the businesses collect data from their customer about what they want, about the customer preference, and from there they get the information about the customer needs, and they provide service or product according what their customer wants or needs. Okay, I believe that most of you have experience on online shopping, example Lazada or Shopee. So many sellers from multinational in this platform, so they sell many things there. They share similar financial system for payments. So there is a lot of things that contribute to globalization of financial market. A convertible currency. A currency can be easily exchanged for other currency. The most easy convertible are called hard currency and include British pound, European euro, Japanese yen, and US dollar. Non-convertible currency. These currency are not acceptable for international transactions. For example, Malaysia currency or Malaysia ringgit, Thai baht, Thai currency, Indonesia currency rupiah, China currency yuan. All of these currency have to be changed to US dollar first for international transactions. So we move to capital flight. The rapid sale of by resident or foreigner of their holding in nation's currency or other asset, usually in response to domestic crisis that cause investors to lose confidence in the country's economy. And foreign exchange. Foreign exchange, all forms of money that are traded internationally, such as foreign currency, bank deposit, check, electronic transfer. Foreign exchange market, the global market for buying and selling national currency. Exchange rate, the price of one currency expressed in terms of another. The number of units of one currency that can be exchanged for another. Currency risk refer to potential harms that arise from the change in the price of one currency relative to another. Table 1 shows US dollar exchange rate for a sample of currency on 17 September 2021. 1 US dollar equal to 4.15 Malaysia ringgit and 1 US dollar equal to 6.46 yuan. Constantly fluctuating exchange rates require international managers to keep in mind three facts. First fact, the price the firm charges can be quoted in the firm's currency or in the currency of each foreign customer. Second fact, because several months can pass between placement and delivery of an order, fluctuation in exchange rate during that time can cost or earn the firm money. Third fact, the firm and its customer can use exchange rate as it stands on the date of each transaction, or they can agree to use specific exchange rate. fluctuation in exchange rate affect both firm and customer. In this slide, I add one graph to show that most of the currency in the world trend from starting from 1980 until 2015. Majority of the currency in the world are in fluctuated in increasing trend, except Japan. They are fluctuated in decreasing trends. So what is the effect of the fluctuated exchange rate to the firms and customer? So we just select one currency in the world as example and how they affect to the firms and customer. Let's say we select one currency, that one is Europe currency and US dollar. Europe currency a bit lower than US dollar. So what's happened? European currency, European firm must pay more for input for US, such as raw material, component, and support service they use to produce finished product and service. And then higher input costs reduce profitability and may force firms to raise price to final customer. This also will affect higher price, reduce customer demand for goods and service. Because of the euro has become less expensive for US customer, firms can increase their export to United States, and firms can even raise their export price and remain competitive in the US market. Increased export to United States can help to increase the revenue and higher profits. How exchange rates are determined? Do you know, class? Exchange rates are determined by supply and demand for its currency. Okay, the greater of the supply of currency, the lower its price. The lower of the supply of currency, the higher its price. The greater demand for a currency, the higher its price. The lower demand for a currency, the lower its price. Foreign exchange involve firms, households, and investors who purchase and sell foreign goods and assets. For example, households buy imported goods for which they need foreign currency to pay for them. Similar to businesses make investment in foreign countries, they need foreign currency for their investment in that foreign country. So this is an example of the situations how you can apply supply and change for the currency. If an ounce of gold is priced you 1,000 US dollar, but you can purchase in Mexico for Mexico's dollar 25,000 with exchange rate 1,000 1 US dollar equal to 20 Mexico's dollar, then according to the principle of the arbitrage. So first we need to compare the price in US, price 1 ounce gold in US dollar. So we convert a price gold 1 ounce gold into US dollar. 1 ounce gold price in Mexico dollar 25,000. So we want to convert this amount to US dollar. So because of we know 1 USD equal to 20 Mexico's dollars, so 25,000 US Mexico dollar divided by 20 Mexico's dollars, so we get 1 ounce of Mexican's gold cost you about 1,225 USD in Mexico. So this price is expensive compared to price of 1 ounce of gold in US. So when you know the price is US, the same amount of price, the same amount of gold sell in US cheaper than same amount of gold sell in Mexico. So what you need to do is Mexico should pay gold in US, which could raise the price of gold in US and then reduce the price difference in between two countries. Emerging of modern exchange rate system during much of the period from the late 80s through 1920s. The Bretton Woods orders, the goal of rebuilding the international money and financial order post-World War II, was embedded liberal international economic order. An attempt to reconciling commitment to an open multilateral world economy with a new domestically oriented priorities of addressing unemployment and social welfare. Bretton Woods order continue. Key element of Bretton Woods Agreement 1944. Gold exchange standard currency were pegged in the relation to the gold content of US dollar. The gold dollar standard or gold exchange standard 1946 to 1971. Many countries fixed their exchange rate relative to US dollar. This was an adjustable peg system as the government could change their peg value to their currency. The currency was convertible for the current accounts, trade payment transactions. Capital movement were controlled, designed to control speculative private financial flow. International Monetary Fund provide short-term loans to help countries finance temporary balance of payments deficit, manage international economic imbalance through oversight of adjustable peg system, leverage use of its lending capacity, and use of sacred currency clause. International Bank of Reconstruction and Development IBRD provide long-term loans for reconstruction and development after the war. World Bank, an international agency that provide loan and technical assistance to low and middle income countries with the goal of reducing poverty. Modern exchange rate system. We have floating exchange rate system and fixed exchange rate system. Floating exchange rate system mostly applied by a strong economic country such as British, Canadian, US, and Japanese. They are floating independently on the world exchange currency. Currency value are determined by market force. They are flexible to modify their monetary policy to fit with the circumstances they face at any time. While the fixed exchange rate system, or so-called peg exchange rate system, mostly applied by developing countries like Malaysia, China, Taiwan, Indonesia, and many more. This peg system they fix their currency into some set value of gold. Some country they fix their value into dollar value. This is important to help developing country to maintain their exchange rate at a fixed price or at the present level. This also help developing country to protect their economy from speculative firms, speculative financial flow. Malaysia in history during the Asia financial crisis in late 1980 have pegged Malaysia currency into dollar. $1 equal to 3.8 Malaysia ringgit. On that time, Malaysia ringgit are fixed for 3.8 Malaysia ringgit into $1. For many years until 2005, Malaysia changed their exchange rate from the fixed exchange rate to floating exchange rate again because Malaysia followed China after People's Bank China removed the peg on their currency. So what happened today? Now for today, USD equal to 4.15 Malaysia ringgit. The monetary and financial system. International monetary system, institutional framework, rule and procedure by which national currency are exchanged for one another. And global financial system refers to the collective of financial institutions that facilitate and regulate investment and capital flows worldwide, such as central bank, commercial bank, and national stock exchange. The growing integration of financial and monetary activity worldwide has several causes, including the evolution of monetary and financial regulation worldwide, development of new technologies and payment systems, and use of internet in global financial activities, increased global and regional independence of financial markets, and growing role single currency systems such as Europe. Key players in monetary and financial system. As companies engage in international trade, they are paid by their customers abroad. They typically acquire large quantities of foreign exchange and must convert them into the currency home country. Firms also engage in investment, franchising, and licensing activity abroad that generate revenue that must exchange for their home currency. Figures in this slide show the key participants and the relationship in the global monetary and financial system. In international organization level, we have International Monetary Fund, Bank for International Settlement, and World Bank. At national government level, we have Customer Bank, or in Malaysia we call Bank Negara. In national infrastructure level, we have commercial bank. As example here in Malaysia, we have CIMB, Bank Islam, and many things else. And we have national stock exchange and bond market. For firm level, we have firm. Key players in monetary and financial system continue. National stock exchange and bond market. Selling stock, share of ownership in an important way for firms to raise the funds they need to exchange in international business. A stock exchange is a facility for trading security and other financial instruments, including share issues by companies, trust funds, pension funds, and corporate and government bonds. Information technology have revolutionized the function of stock markets, greatly reducing the speed and cost of transactions. For example, Tokyo Stock Exchange (TSE) is the most home stock market to such firms as Toyota, Sony, and Canon, and a major vehicle through which some 2,000 Japanese firms raised capital to fund their business activity. In Kuala Lumpur, Malaysia, we have Kuala Lumpur Stock Exchange, Malaysia. Key players in the monetary and financial system continue. Now we are in commercial bank. Banks are important players in the global financial sector. They raise funds for attracting deposits, borrowing money in interbank markets, or issuing financial instruments in the global money market or security market. For example, Bank of America, Mizuho Bank in Japan, and BBVA in Spain. In Malaysia, we have a few commercial banks. Some of them are Affinbank Berhad, Alliance Bank Malaysia Berhad, and Bangkok Bank Berhad, Bank of America Malaysia Berhad, Bank of China Malaysia Berhad, Bank of Tokyo, Mitsubishi UFJ Malaysia Berhad, and CIMB Bank Berhad. Now in this slide, we want to know a type of bank and their function when we are dealing in international business. There are many types of bank and their primary activities include the following. Investment bank. Underwrite, guarantee the sale of stock and bond issues and advise of mergers such as mergers of the Goldman Sachs in the United States and Nomura Security in Japan. Merchant bank. Provide capital in firms to the form of share rather than loans. They are essentially investment banks that specialize in international operations. They do not provide regular banking service to general public. The Arab Malaysia Merchant Bank is an example. Private banks manage to assets of a very rich Union Bank in Switzerland, UBS, and ABN AMRO Private Bank in Luxembourg are examples. Offshore banks are located in jurisdictions in which low taxation and regulations, such as Switzerland and Bermuda. Banco General in Panama and Bank of Nova Scotia in the British Virgin Islands are examples. Commercial banks deal mainly with the corporate and legal large business. Credit Lyonnais in France and Bank of America are examples. Key players in the monetary and financial system continue. Now we move to talk about central bank. Central bank refer to official national bank of each country. The central bank regulates the money, supply and credit, issue currency and manage the rate of exchange. To ensure the safety and soundness of the national financial system by supervising and regulating the national banking system. Central bank regulate the nation's money, supply and credit by buying and selling money in the banking system, increase or decrease interest rate on fund loan to commercial bank, buying and selling government security such as treasury bill and bond. Monetary interventions by central bank, the buying and selling of the currency by the central bank to maintain the exchange rate of the country's currency at some acceptable level. Key players in the monetary and financial systems continue. Now we talk about the banks of international settlement and International Monetary Fund. Based in the Brazil, Switzerland, the Bank for International Settlement is an international organization that fosters cooperation among central banks and other governmental agencies. International Monetary Fund, headquarters in Washington, D.C., the IMF provides the framework of this determines the code of behavior for international monetary system. To help manage currency valuation worldwide, the IMF established a type of international reserve known as Special Drawing Right (SDR). Special Drawing Right (SDR), a unit of account or reserve asset, a type of currency central bank used to supplement their existing reserve in transaction with IMF. The global debt crisis, growing imbalance in financial of numerous national governments is an emergence crisis in the national monetary and financial environments. Debt is especially high in Japan and Greece. In these countries, as well as Belgium, Italy, and United States, gross government debt exceeds 100% of each nation's GDP. Research shows that national debt that exceeds 90% of national GDP tends to diminish GDP growth, which exacerbates government debts. Numerous countries have surpassed this threshold. Firms doing the international business must proceed with caution because massive government debt can indicate economic instability, reduced buyer purchasing power, and other challenges in national market. This slide also complement with the figure about the world debt and gross GDP. These figures show the amount of gross government debt as a percentage of GDP for selected countries like Japan, Greece, Italy, Belgium, United States, France, United Kingdom, Egypt, Canada, Germany, and Norway. From this figure, Japan most highest in debt of their country. Okay, we are at the end of this slide. So that's all about issues in international finance. Thank you very much. Have a nice day.